Welcome back, guys, to another episode of 3 Stocks I'm Buying, and today we have the August 2019 edition of this series. So in this video, what I picked was one high-risk stock, one medium-risk stock, and one low-risk stock. And the reason I did this was to give you guys more of a variety of different types of stocks out there, so you can take these, research them further, and find out if they're a good investment for you. Now, if you appreciate my work on this video, all you have to do is drop a like down below. It really means a lot to me and it really helps out the channel tremendously. So thank you in advance for that. But anyways, you guys are here for 3 stocks, so let's get into our first pick here. Let's start off with the low risk stock, which is Johnson & Johnson. So these guys actually have a massive $350 billion market cap. If you haven't heard of this company before, they're a massive pharmaceutical company. And this is honestly just one of those stocks that's just such a consistent climber. Year over year, you get gains on the stock. Year over year, they keep increasing their dividends on the stock. And year over year, investors are happy holding this stock. So we'll talk more about the dividend in just a couple of minutes, but if you're not familiar with Johnson & Johnson, the company, pretty much what they do is 3 main things. They focus on the consumer side and on the business side. So the first thing that they do is actually consumer-related products. Now this is of course their baby products and their Band-Aid products and other healthcare-related products that many of us use on a day-to-day basis. The second is that they have a good presence in the medical device space, producing products to help with surgeries and other operations. And their last big segment here is of course the pharmaceutical space, where they produce products and pills and medicines to fight viruses and diseases. So all in all, this is a very diversified stock in the healthcare space, and it's highly regarded as one of, if not the best pharmaceutical stock to hold in any portfolio. Now the question is, why are we talking about Johnson & Johnson today? Over the last few weeks, the stock has come under some fire and it has corrected. This may be a good opportunity for us to pounce in here and pick up this company at a discount. So the reason that the stock price dropped actually was because the Department of Justice, the DOJ, is actually investigating Johnson & Johnson on if they lied about possible cancer risks from its talcum powder. When governments step in against a company, this is typically seen as a big negative for a company because governments can go in, put some regulation on the company, and that could affect the growth and the profits of the company. So as a result, investors start selling their shares because they don't want to hold out to see if that worst case scenario plays out. And just over the last month or so, Johnson & Johnson has corrected about 10%. Now 10% might not seem like that big of a deal to many of you, but when you consider a company with a market cap of over $350 billion, 10% equates to quite a big chunk of value that this company lost. And in the middle of all the stuff that's going on with Johnson & Johnson, they came out and reported their earnings, which pretty much got overlooked because of all this bad news. And their earnings once again came in fairly strong. The company continues to invest heavily in its R&D with $2.7 billion invested in its last quarter. And it continues to return value to shareholders from share buybacks of $2 billion in the last quarter, and of course through dividends with around $2.5 billion paid in the last quarter alone. So now speaking of dividends, let's take a look here at Johnson & Johnson's history with that. Currently they pay out a yield of just under 3%, which is a strong yield, starting yield for a company this size. And their payout ratio is in the mid 40%, which make it very sustainable over the long term. On top of this, Johnson & Johnson is also a dividend king with 57 years of consecutive dividend growth. This gives investors tons of confidence. Any dividend investor really looks at Johnson & Johnson as one of their top picks in there. And this will continue, in my opinion, moving forward because of that low payout ratio. Now, although their growth rate might not be as high as other stocks, a 7% rate for the last 10 years is still impressive for a company of this size. And you can see that even through the last 2 recessions in 2000 and 2008, the company continued raising their dividend and kept their shareholders happy. Now, the average analyst consensus here on Johnson & Johnson is nearly a 20% upside, which makes sense as the stock did take a hit recently, just like we went over a couple minutes ago. Analysts continue to remain optimistic on this company with a buy rating across the board from some of the largest analysts and most respected analysts out there. And this really makes sense in my opinion. The company has a current PE of around a 22, but a forward PE of around a 14, making it a massive bargain if sales perform as expected over the next year. So I believe that the market is actually severely undervaluing Johnson & Johnson at this point, as you can see by the 4 PE here, which is extremely low in my opinion. And a lot of this is being stemmed from the fears of the Department of Justice, the investigation that's going on, and really you can conclude that fear has taken over this stock currently. Finally, taking a look at Johnson & Johnson's chart here, you can see that their weekly shows us that the stock consistently comes back to the 200 moving average every so often, but this is where buyers step in and move the stock higher. It looks like we're heading for this kind of scenario yet again, and as a result, this could prove to be an excellent entry point over the long term for this company. In my opinion, the pros for Johnson & Johnson severely outweigh the con here, which is the Department of Justice investigation. In my opinion, if the company is found guilty of this, yes, they probably will face a fine, but it'll most likely be a one-time fine that they pay off, and then it's pretty much smooth sailing from then on. Now, although there is a moral aspect of investing in a stock like this, if they intentionally put stuff in this powder that cause harm to people, that may not be a company that you may want to invest in because of the moral aspect. But again, if I look at the pure business side of this company, things are looking extremely strong. All right, now let's move on to our second pick of this month, which is a more medium risk company. Of course, you've heard of this company. I'm sure you guys get things delivered by this company. And I'm not talking about Amazon, I'm talking about FedEx. Now, some may argue that this is also a low risk company, but my reasoning for it being a medium risk company is because when you look at the stock over the last year and a half, this company has corrected around 45% in that time period. And because of this massive correction, because of this volatility in the stock, I would consider this a medium risk company. FedEx, if you're not familiar, is actually a large shipping company that ships products across the country and across the world. They're one of the dominant players in this space alongside UPS and other companies like DHL, but they have a pretty strong hold on the shipment market here. Lately, however, there have been fears about Amazon competing with them or not using their service as much anymore, and as a result, this led to FedEx stock taking a big hit. However, FedEx did come out and state that Amazon actually accounts for less than 1.3% of the company's revenue, and Amazon isn't even their largest customer. Remember, FedEx is a worldwide company, not just a company that serves the US. And because of this, they have a lot of diversification and they have a lot of different markets that they go after. The other fear around a stock like FedEx is about a global economic slowdown, which would affect a company like this. And back in December, if you look at the stock, you can see that it actually plunged around 33% in a single month, which spooked a lot of investors. Since then, though, it has found some stability and has been hovering around this level, creating kind of a bottom here, as investors still remain cautious on the global economic outlook. Now, FedEx is another strong dividend growth company which has a lot of upside, and although its starting yield is around 1.5%, they only pay out around 17% of their earnings and dividends. Now, this could be because they're also cautious about the economy right now, and their business is in a segment that will suffer if the economy enters a recession. So it's a good thing to see here that they're well aware of this and they have taken measures accordingly to have a dividend, but have a safe and consistent dividend here for investors. But on the flip side, they have been growing this dividend for 17 consecutive years. So this is a company that has gone through the last recession and has come out of it stronger. Their dividend growth rate has accelerated tremendously in the last few years, but we may be entering a stage where we won't increase as much in the next few years. The 10-year growth rate is around 19% and the 5-year growth rate is around 33%, which are absolutely incredible numbers, but not very sustainable over the long term at such a high clip. But like we saw, that low payout ratio does help keep them in a position where they can continue growing that dividend. Now, analysts do see some upside here, but based on the upside, it seems as though they believe FedEx is fairly valued when considering the current economic conditions and outlook. In my opinion, though, I think this is a stock that is severely overlooked because they have a forward PE of around a 10. So it looks like the potential of bad news here with an economic slowdown or recession is getting priced into this stock before we even see that. And finally, now looking at charts of FedEx here, you can see that the monthly shows that the stock found support at the 100 moving average and has since started to show signs of recovery. Like I said, at current prices, I believe FedEx is very undervalued here, and that a $200 price target on this stock isn't as far-fetched as some may think. And although competition is going to continue getting tougher and tougher in this space, I think that FedEx has a very strong hold on this market. They have the logistics in place, they have the fleet in place, and they have the manpower to actually weather any sort of competition that enters here. It'll be very difficult for any company, even a massive company like Amazon, to enter the space and take down a company like FedEx. But it doesn't hurt to be cautious here if you are an investor in FedEx or considering investing in FedEx, because Amazon is in this space, and if they do plan to invest heavily in this space, you may see them eating more and more into FedEx's portion of the market. So our third and final stock here is a high-risk stock. I'm sure this is what a lot of you are waiting for. And this is a company that we have covered on the channel before. It's a company that I think has absolutely been destroyed in the last year and a bit, but I think it provides a lot of great upside in the coming years. These guys are an e-commerce giant. No, it's not Alibaba. It's actually their biggest competitor in China, and that's JD.com. Many of you are familiar with JD.com if you've been following the channel for a little while. But if you're not, in a nutshell, really, JD.com is another Amazon really in China. They have over 300 million active customers, 550 warehouses for all their logistics, and last year they pulled in over $67 billion in revenue, so this isn't a small company by any means. But because of all the trade tension that's been going on, JD.com has taken a pretty hard hit here, and the company currently sits at a measly $45 billion market cap, well under the amount of revenue that this company brings in. They also have a forward PE of around 30, which is very reasonable in my opinion, considering the growth that this company has experienced recently. Looking at their financials, you can see here just how quickly the revenue has been growing year over year, demanding a higher PE than other companies. Now the concern here with the stock is that their profitability is pretty much non-existent currently, which is why there isn't as much love for the stock right now in my opinion. That being said though, I do believe that they are on a path to massive profitability, similar to Amazon and Alibaba, and it's just a matter of time before we start seeing this in their numbers. At this point though, I do believe the stock has massive potential to possibly reach a well-deserved $100 billion plus market cap. And of course, because this is a high growth company, there is no dividend being paid out. And also because it's a high growth company, you see a lot of risk associated with this, which is why I gave it a high risk rating here. China isn't growing as fast as it used to, although it's still growing much faster than the US, but there are fears that this could continue slowing down and we could see steeper declines in the coming years. As a result, JD, with many other Chinese stocks really, are suffering tremendously. Analysts here see around a 15% upside in the stock, implying that some pretty good growth in the short term is possible, but this is only if things start to go JD's way. In other words, ideally we'd want the trade deal to complete, we'd want China's economy to start picking up again, and if these two things play out, then we could possibly see JD at a $50 stock once again. The charts here for JD kind of show us just how drastic the drop was in the stock recently, going from over $50 a share to under $20 a share in less than 1 year. And that's the kind of risk and volatility you accept with a stock like this. That being said though, it's currently sitting above its moving averages on the weekly, which is a bullish sign for a stock, implying that it's ready to move higher soon. But this will really be dependent on things like we talked about previously. Personally, I believe that the risk to reward ratio here for JD, even though it is a very highly volatile, high risk stock, is worth it for me personally, because it does provide some upside over the very long term. And I do see a path to profitability, similar to how Alibaba and Amazon were able to do it as well. So guys, now out of these three stocks, if you were given, say, a hypothetical $10,000, how would you distribute them across these three companies? Would you go 100% in Johnson & Johnson? Would you maybe go 80% Johnson & Johnson, 10% in the other two? Or maybe you distribute them evenly between three stocks? Let me know down below how you would distribute a hypothetical $10,000 in these three companies. Thank you so much for watching, guys. Don't forget to drop that huge like and subscribe down below if you're brand new to the channel. I appreciate you watching up till the end here. And just as a thank you, guys, I do work with Tip Ranks here, and they do provide a 20% discount if you guys want to sign up with their service. Completely money back guaranteed for 30 days if you're not happy. Anyways, use the promo code POSITIVE2019 when signing up, and that'll give you 20% off. Thank you again for watching. Hope you enjoyed this video. Don't forget to press positive, and I'll see you in the next one. Peace.